Hello and welcome to BQ Prime. India's inflation for the month of August has come in at 6.83%. That's compared to 7.44% in July. And that's also lower than the Bloomberg Economist estimate of 7.1% for August. The decline is led by vegetable prices. Now we're in conversation with Upasna Bhardwaj, Chief Economist at Kotak Mahindra Bank, for early insights into CPI as well as IIP figures that were released today. Hi Upasna, thank you so much for taking time out for us today.
Hi Pallavi.
So, to begin with, I'd just like to ask you, what's your early take on both of these numbers? CPI was a tad bit below economist estimates. IIP too seems to have surprised on the upside.
Absolutely, Pallavi. Actually, CPI is absolutely in line with our expectation.
Okay.
We were at 6.86, so it's just 3 bases lower. And yes, IIP is higher than our expectations. There is a segment of manufacturing which is slightly higher than what we were expecting. We were at 5%, 5.7 is the number. Now, this is overall in total, if we look at the mix that has come, it is a much softer inflation and a better than expected IIP data. So clearly this is something to be happy about. But having said that, these numbers do especially the inflation numbers, we should keep in mind that, it is higher than RBI's own comfort threshold that we look at, which is 6%. So while, yes, it's a relative concept, we are looking at it vis-a-vis 7.44% in the previous month. And hence, a softer reading is definitely welcome. But clearly, it still remains higher than RBI's 6% threshold. And at the same time, even the next reading is going to be just around 6% handle. So we should keep our fingers crossed, because much of this slowdown that has happened, or moderation inflation that has happened, is because of the vegetable prices reversing. The perishable items, we've seen a reversal in prices there. But having said that, if we look at some of the other parameters like cereals, pulses, these are the ones which act as structural floor they provide to prices and to headline inflation. And that is something which is holding up. So the prices of pulses is still quite elevated, and we'll have to be maintaining a quite close watch on these numbers, because they could result in a much more generalized inflation. And that is something which we'll have to be worried about.
All right. So, like you said, vegetable prices appear to be on a little bit of a decline. Even high-frequency data for September appears to indicate a continuing easing in vegetable prices. However, pulses, as you pointed out, remain a point of concern. There continue to remain a lot of headwinds when it comes to food inflation, given the volatile trajectory we have seen of the southwest monsoon so far. The IMD has predicted a normal monsoon in September. How that impacts, Kharif sowing, though that's largely completed, how that will impact Rabi sowing. What's your take on all of this? I know it's a little bit of a wait and watch situation, but what are you making of the situation as of now?
There are 2-3 aspects to keep in mind. Most of the Kharif sowing is done. So now it's about the output that we're going to be looking at. The second important aspect is that if September rains are not adequate, then the Rabi sowing and all gets impacted. The moisture content will have a bearing on Rabi sowing. So it could have the potential to keep inflation high for long, especially I'm talking about the food inflation. There is too much of volatility. Perishable items still can be managed, but like I said, pulses, cereals is something which we'll have to be very closely watching out for. But having said that, I think a more important aspect is that this can be, to an extent, managed through supply-side interventions by government measures. And the government is taking certain measures to manage or rather I should say, to cap the upside price pressures on some of these important essential commodities. So we are seeing those measures adequately to cap the surge, but nonetheless, the risks are very high. And like you said, it is about somewhere, if the moisture content is not good, then it also impacts the Rabi sowing. And we'll have to be very watchful on that as well. So food inflation going ahead is something which will be a reasonable source of volatility. And that will also be the reason why it will be very difficult to chart out a clear path of the headline inflation over the next 6 months.
All right. That given, would it be fair to say, considering that the Monetary Policy Committee has gone on to reiterate that they expect the food-driven inflation, the rise in inflation to be transient, can we expect the MPC to continue to remain on pause mode for the rest of this year?
That is our base case for now, if you ask me. But having said that, again, like I said, it's very volatile. The situation is very volatile. At the moment, in the previous policy, the MPC had given out the second quarter inflation estimates at 6.2%. There itself, we were looking at almost a 40-50 basis of an upside to their estimates. So now, currently, there will be about 50 basis of upside to the second quarter estimates of RBI. Having said that, if things were to normalize beyond a month or two, and then inflation could moderate towards a little at around 5% or a little below in the next 6 months' time. Once that happens, it could provide, if the clarity on that trajectory is there, it could provide breathing space to MPC to maintain a status quo on rates. But we'll have to be very watchful on every reading, all the high frequency data, what is this that's suggesting? And hence, at the moment, I would say risks are evenly balanced to the view of a prolonged pause.
All right. So, moving on to the figures that we've seen for industrial output grew by 5.7% in July. However, on a month-on-month basis, it appears to have moderated by 1%. So overall, what's the reading on the IIP?
IIP, if you look at the breakup, I think more from the user-based point of view, it is largely the consumer durables which is contracted, and that is not really showing any signs of improvement. That is also a reflection of the guidance that we have been getting from a lot of FMCG companies, which is suggesting a patchy consumer demand, I think. So that remains a point of worry. Infrastructure and construction remains fairly comfortable. Now, if you're looking at a month-on-month reading, we have to put it in the context that July, like for example, most of the construction activity, mining activity, all of that takes a hit because of rains. So it's a seasonal pattern that we tend to see. I don't think at the headline level, the month-on-month numbers are really something to worry about. They are seasonal, and the seasonal adjustment numbers are broadly in sync with what we were expecting. A slight, in fact, improvement, I would say, across certain segments. But I'd be more worried on the consumer demand side. The consumer durable segment is still lagging quite significantly.
Also, the fact that these are figures that we're seeing for consumer durables right before the festive season, or rather right while we're in the middle of the festive season. So, what does that say about demand? Like, even from a slightly longer term perspective, is that a little bit of a concern? Like, Q1 GDP was released recently and private demand seemed to have held up. So, do you expect, going by current trends, that private demand will weaken in the following quarters?
Yes, we are looking at some fatigue setting in. And I think the early indications we'll get is in the footfalls for the festival seasons. There is a possibility that we get some kind of, positive announcements which would be supportive of consumer demand ahead of the festivals. We'll have to look out on the fiscal announcements, if at all there is any such support coming. But having said that, I think if you look at the elevated inflation, cost rate of interest are high, and alongside there is a lot of fatigue which is setting in the rural segment particularly. All of this is expected to keep the consumer demand weak going ahead. So while we did see a reasonably decent number in the first quarter, much of it also was supported by base effect. I think all that base effect is expected to wane off now. And going ahead, there should be some moderation in activity. So I do expect consumer demand to remain weak in the subsequent quarters.
All right. What are you making of other high-frequency indicators? It does appear to be a little bit of a mixed bag.
Absolutely. That's the whole point. So we are holding up, actually. I would say broadly, the economic data is still holding up quite well. I'll have to look at the details of IIP for this reading. But in the previous segments, the previous month also, we have seen that there is about 55% of the industries which have still not caught up with the pre-pandemic levels. So, if I look at the details for this month, I'll get a better picture on how things would be panning out. But that has been a sustained trend. So we still have it's like a mixed bag wherein quite a few industries have yet not, or sectors have yet not caught up to the levels seen pre-pandemic. And until that is not really achieved, we will continue to see a very patchy recovery across manufacturing. And that is going to be the way ahead as well. I do expect manufacturing sector to be lagging behind in the next few quarters overall. And that will have a bearing again on consumer spends, because if manufacturing sector is lagging, then so will the employment absorption in that sector. Wage costs are going to accordingly get readjusted. And at the same time, like I said, the rural segment too will be under stress because of the monsoon-linked uncertainties. And all of this should be slightly having adverse bearing on growth.
All right. Upasna, thank you so much for taking time out for us today. This was a most insightful conversation.